I'm going to start the today's session. So as you see this slide, I have already covered you the incorporations and licensing of finance institution, shareholders' rights, and then compliance, corporate governance, and risk management, liquidations. So these are the topic I covered already. And I hope Mr. Gamanayaka would have covered the group and organization structure, expansion strategies, corporate strategic planning, and financial fraud. Isn't it? Okay. Then two more sections need to be covered by me. Two more sections need to be covered by me, which is financial reporting and analysis and audit. So, in the financial reporting and we have, I think, 3 more classes. So, I try to cover these 2 topics within these 3 classes, and then we can complete this session. We can complete the session, and then I think the 12th of November we are having the revision classes, revision sessions. So you can, if you participated, we will do that past papers, all 3 past papers, last 3 past papers, as well as some just cover the important topics in a very broad manner during, and that's my plan. Actually, I wanted to tell you the plan, then it's easy for you all to prepare the exam as well. And then I think the end of this year or beginning of next year there will be an exam. I think date has not been decided yet, but this is the planning. But of course, during the pandemic, anybody can plan anything, because it's very uncertainty. So that is idea. So with having this, I'm going to start the financial reporting and analysis today. Before I start the class, as usual, I just wanted to reiterate that if you wanted to ask any questions, you can unmute your microphone and ask directly, or as usual, you can come through the chat box or inbox. So that is there are 2 ways you can ask the question. So okay, before going to the topic, or before starting the discussion, you all wanted to ask anything from me, then I can just clarify that and all, because you can ask anything, even the corporate governance or compliance or risk management, any of the previous topic, and this particular session before we have discussed. Anything you all wanted to ask?
No, sir.
Okay. Thank you so much. Then with having that things, I just move into the financial reporting, today's thing. Before seeing that what is financial reporting, we have to see why we need the financial reporting. Of course, many stakeholders need the financial reporting for various purposes. The management may expect the purpose, various purpose, one purpose, and shareholders may be one purpose, and depositors may be one purpose if it is the financial institutions. But generally, why this financial reporting is important for a company? Because as we have discussed already in our previous classes, in a company there is a peculiar characteristics prevail. The owners are different from the management people. Then the management people manage the company on behalf of the owners. Okay, the owner's capital is in there, and even if it is a bank, okay, depositors put the money. So owners and depositors, ultimate beneficial people, are different from the managerial people. Okay, then the management people has the obligations to report their performance time to time. They have to report their performance time to time to the shareholders as well as depositors. So that is the purpose. This topic is getting important here because these are the owners are separate from the managerial people. So they are given freedom to do whatever they want in the sense in a good for a good purpose of the company. But end of the period, they have to say, okay, this much of the profit we have earned and this much of the asset and liability we are maintaining and this much of current liabilities are there. Likewise, they have to give a clear picture of the company to the stakeholders, mainly to the shareholders. Okay, that is the purpose why this financial reporting is important. Okay, so by definition, what is financial reporting? It is a process of producing statements that disclose an organization financial status to the relevant stakeholders. Okay, it says it's a process of producing statements that disclose the organization financial status to the relevant stakeholders. Okay, here the important word we can say that producing statements. Okay, in the financial reporting, there are 5 statements are mainly produced by the management to the stakeholders. Okay, what are those statements in a finance? If you are accounting students, or even if you are working in the bank, you all may get to know that you all may already know that in the financial statement there are 5 main components in the financial statement. We will discuss that in a detailed manner. But before starting, they just have an introduction. Okay, can someone tell me what are those 5 sub statements or statements in the financial report? Statements. What are those? Any volunteers? What are the statements released by the management to the stakeholders as financial statements? Or what are the statements included in the financial statements? There are 5. Can someone
Balance sheet, statement of cash flow, profit and loss statement.
Yes, you're right. 2 more.
I can't recall, sir, the other 2.
Yeah, actually, the balance sheet, you are rightly saying that it's a balance sheet. The first, most important, any person will look into the balance sheet and P&L. Of course, we will discuss later on. The P&L can be divided into 2 under this SLFRS 9. We can, but mainly the P&L, profit and loss account. Other one is equity movement statement. Equity movement statement will say about will disclose the how the equity fund of the company moved and what are the additions have been included, what are the things has been eliminated, and then cash flow statement, and finally notes to the accounts. These notes to the accounts also as important as balance sheet or P&Ls, because these notes give additional information about the financial statements. So even if you see an annual report of any finance companies or any bank or any of the listed companies, you can see that there are in some items number, they will just numbered it, the note number. So, for example, if it is the loans and advances, they will, if it's a financial assets, they will put the note number. Then in the note, they will disclose that, okay, what are the financial assets the company is having. If it is an investment in subsidiaries, there's a note, and what are the subsidiary, what are the investments considered as a subsidiary. Likewise, the notes to the accounts also that important. So there are 5 items produced by the management as a financial statement: balance sheet, P&L, equity movement statement, cash flow statement, and notes to the financial statement. So, process of producing these statements, these 5 statements that disclose the organization financial status to the relevant stakeholders or users is called financial reporting. And this as I already mentioned, internal and external stakeholders are interested on these financial statements. Who are the stakeholders? Generally, stakeholders of a company. Generally, the owners are the stakeholders, depositors are one of the stakeholders, and regulators are one of the stakeholders, and even the management is one of the stakeholders. Employees are one of the stakeholders. Likewise, there are so many stakeholders. Tax department, government may be one of the stakeholders. Environmental authorities may be one of the stakeholders. Stakeholders mean interested people. So there may be several stakeholders for a company. So these stakeholders, it may be the internal stakeholders and external stakeholders. The internal stakeholders in the sense, those who are within the management, maybe the management or the employees or somebody else called as internal stakeholders. And external stakeholders, accounting body and regulators, government can be called as a external stakeholders. So internal and external stakeholders are interested on the information disclosed in the financial statements. So the next item we are going to see why this financial information needed for the stakeholders, because every stakeholders doesn't have the same motive or that doesn't require the same information. Different stakeholders require different statements. For a management, it is why they want the financial statement is to plan and manage the business and take important business decisions. For example, the management wanted to expand their operations or expand their branch network. Okay. So they can't just take the decision, okay, we will expand the branch network by 10 branches or 20 branches or 5 branches. They can't just take the decision. They have to see about the financial statement, whether the company or financial institutions are able to afford that branch expansion. Even any branch, any bank or finance companies, if they open any branch, it may not be profitable. It may not be profitable in first few years. And first few years, they have to get, the branches, particular branches may incur losses. Or comparably, the profit margin may be low, very less. And they may have to incur more capital expenses to open a branch network. Okay, then this the particular company or financial institution should have a sound funding requirement. To meet the sound funding requirement, they should have the sound financial statements or financial position to expand the branch. So for that purpose, management may be interested on the financial statements. So plan and manage the business to take the important business decision. They need the financial report, financial statements. And shareholders and prospective investors. That is other important. I have already mentioned, because shareholders always they will think about it. 2 things they will look into that. First is, okay, my first one thing is they will think about it. Okay, whether company earn enough profit for my investment. That is the first and foremost. They will just look into that. Okay, earning per share. What is the earning per share? Or return on equity. What is the percentage of return on equity? We will see this, the sum of the ratios later on. So they will just discuss about. They will think about. They will consider or concern about return on equity or earning per shares, whether the company earn adequate profit for their investment. That is the first thing a shareholder may be worried about or have a concern on this. The second thing is whether the company has the adequate value for their investment. So basically, they will check whether they have enough net assets for their share price. Actually, it is very important, but unfortunately in Sri Lanka, most of the investors doesn't look. Most of the investors, they don't look at these things. They just, what they are doing in the even the stock market investment and all, what they are doing is they are just investing some share. Okay, everybody is going beyond some shares, share X, then everybody just invest. It is not nice to mention a company name. They recently, you will as a banking students, you all must know about it. Recently, actually, what is the trend of this stock market currently? What is the trend of the stock market currently? Whether it's a bear market or bull market, or whether the investors are having a good time, or what is your understanding? Can someone? Yeah, can someone say that what is the trend of the stock market currently? As a students, it's important for you all to read and understand the current situation of the country. Better read the Financial Times or Daily FT, Daily FT, or any other papers, business pages, and just keep in touch with those things. Actually, in our institution, of course, in the early morning we had to read at least 2-3 papers and has to just have a current idea about the current business environment. Okay, can someone tell that what is the current trend of the stock market, Colombo stock market? Somebody said that it's bear market. I think I'm just confused. I think it's a bull market. It means the market is performing well, and our OCHA price index increased from somewhat around 6,000 level to 9,000 level, even though there are fluctuations, and most of these investments or most of these stock market activities are mainly driven by domestic investors, and the contribution of the foreign investors declining or decelerating throughout this last year and this year. Most of the foreign investors take out their money from the stock market, but due to the low interest rate scenario, this most of the domestic investors attracted by stock market, and there are the stock market performing well, and investors are getting more profit. But when they are, my concern is, this is my very personal opinion, my concern is investors doesn't look at the balance sheet and P&L and do the adequate analysis before they are investing. Generally, what they are doing is they are just looking the trend of the market. Okay, if everyone buying a particular share, and they also buying the particular shares. If you read some good investment book, share market investment book, and Warren Buffett some analysis and all, you can identify that there are so many things we have to look into the stock before investing in the stock market. Why I'm saying this, shareholders and related to shareholders and prospective investors aspect. One of the company I know that it's not nice to mention the name. I know that it traded less than 2 rupees. Suddenly it went up, and some 150 rupees or something. But the net asset value of that particular share is just 13 rupees. I don't know why our investors are such a crazy to that investments and without any basis. Likewise, this is one of the example. Likewise, there are some other cases also. Then some people, it is my personal opinion, market is overheated by the investors. So why it's happening is the shareholders or prospective investors doesn't have much analysis on the stocks. So that's why it says that the shareholders and they are much more to assess the return on their existing investment and viability of investing and in the future as a future business. They have to much concentrate on the the financial statements of the companies. Okay, the third one is depositors to make sure the safeness of their deposits. Actually, this is also one of the theoretically expected things, but none of the things, most of the depositors doesn't do anything. Before investing in a particular bank or finance companies, our depositors, Sri Lankan depositors, what they are doing is they are just checking the interest rate. If some finance company offer a high interest rate, they just blindly go and put the money into that particular finance companies. They don't check the financial condition of the particular finance company. So what happens is something goes wrong, that actually it's a basic idea. If someone offer the high interest rate, it implies that there's a high risk. So actually, theoretically, it is expected that depositors, to make sure their safeness of their deposits, what they have to do is they have to analyze the financial reporting. At least they have to see whether the company is profitable, whether the company's net asset value is representing net asset value is positive. They have to see it. So for that purpose, depositors expect it. And the regulators, of course, the regulators to assess the level of the risk, availability of the resources to mitigate the risk, to check the compliance, to make policy decision, and to evaluate the transparency of financial information. So, and other information, for other purpose as well, they are interested on financial reporting or financial statement of the companies, particularly the financial institutions. Actually, when they are assessing the risk, okay, what are the risks they have to think about it? Okay, we have studied about the risk. Just to refresh your mind and just to refresh your topic understanding, I like to ask from you, okay, what are the areas a financial institution can expose the risk, or what are the risks we can identify in a financial institutions? What are the risks? Can someone? What are the risks we can identify in a finance institution, bank or finance companies? We have studied. What are the risks a bank can? What are the risks
Credit,
identified in a bank? Sorry.
credit risk, market risk, liquidity
Yeah.
risk,
Credit
operational
risk.
risk,
Yes,
liquidity
you are
risk.
right. The credit risk, market risk, operational risk, and liquidity risk, etc. And resources, of course, the capital and liquid assets. Generally, we consider the resources capital. Capital is the main resources we are considering to mitigate the risk, because to absorb any unexpected risk, there should be adequate capital. So that is the resources. And the risk can be credit risk, liquidity risk, market risk, and so on, operational risk, so on. Okay, so to assess the level of the risk, availability of the resources to mitigate the risk, to check the compliance level, because time to time regulators are issuing the some directions and circulars, so they just check the compliance level. And for example, as usual example, uh, liquid asset ratio, they are always concerned about the financial statement and check whether they are having adequate liquidity, whether they meet this liquidity requirement, compliance level. And to make the policy decision and all, the regulators are interested on financial reporting or financial statement of the company or financial institution. The other one is employees. In making bargaining agreement, in discussing compensation and promotions and ranking, they are worried. They have a concern on the financial statements. For example, currently the banks are recording a higher profits compared to last year. So the employees are having the bargaining. Okay, then they expected. Obviously, they may expect higher salary or higher bonus during this period. So they are concerning about the financial statement for their purpose. And rating agencies, of course, they do, to rate at their company, then credit worthiness, to assess the credit worthiness of the institution, and particular instrument. What are the instruments? It may be debentures, so credit instrument. So to assess the rating and all, the rating agencies are interested on financial report, financial statements of the company, and other financial institutions to make the lending decision and all. Because even though in the bank to bank lending or finance companies to finance companies lending, they will measure the risk of that particular other account of finance institutions. So to make the lending decision, they need they concern about the or they are interested on financial reporting. And the government agencies, of course, I need not explain much. If it is a tax or so regulatory institutions and other, they are just interested on uh, the financial statement of the company or financial institutions. Okay, these are the things we have studied. First, what is the financial reporting process, and why financial information is needed for the stakeholders. The different stakeholders having different idea, and for different purpose they need the financial information. Anything you all wanted to ask, you all can ask. Okay, then I'll move to the section. In the financial reporting, of the preparation of financial statement and disclose the financial reporting, there are several processes involved in the company, in a company operations. So by end of the year, first what they will do is the accounting department or finance department, they will draft the financial statements. Okay, so if those who are working in the banks or is particularly in the finance divisions, they may know about it, but others, it is useful for others to get to know that. So that they will draft a finance department, draft the finance statement, and they will submit that finance statement to the board audit committee. This is before starting the external audit. The internal audit committee, they will submit the draft financial statement to the board audit committee. Okay, then board audit committee will review the accounts, draft account, and once they satisfy it, and they will pass it that accounts to the board of directors for the review. Okay, then but the board of directors also will review, and they will get some additional information about the financial statement. So once they satisfy, they will pass that to the audit purpose, commencement and audit. After that it will start the commencement of audit. So auditors may do their audit and check the accuracy of the true and fair view of the financial statement and all. Then if there is any weaknesses or anything, what they will do is they will inform that weaknesses or any deficiencies in the financial statement to the management through a management letters. Okay, so once they receive the management letters, then the management will rectify those weaknesses and any deficiencies. So once it's adjusted, then the audited financial statement will be finalized. So once it's finalized, it will again go to the board of directors, and once the board of directors approve, that will be published as an annual report. So how many of you all see the annual report or having the habit of reading the annual report? Have you all read any annual report? Actually, it gives some interested information about the company or bank, or actually it's better for you all. It's a good practice for you all. Just take one of the company, one bank or finance company's annual statement, annual report, and read it. There are a lot of information about financial statement and the company's the operation activities, what are the new activities companies, and their risk management reports disclose the risk management, and there is risk management practices and process and all. So this is one of the way just reading. So they will just publish the annual report. So this is all these process involved in a publishing or the annual the financial statement or annual report. And there are some legal and regulatory requirements on the financial reporting of financial institutions. Okay, why? Okay, everybody knows that therefore the management are different from the shareholders. That's why they are doing the financial reporting. But there are, in addition to that, there are some legal and regulatory requirements. So what are the legal and regulatory requirements for the bank or finance companies or insurance company? The first one is, according to the Sri Lanka accounting standard, they have to prepare and publish the financial statements. So there are some accounting statements, accounting standard, which require every company has to follow certain procedure and publish the statements. That is first thing. And if it is the banking act, of course, if it is a bank or licensed bank, then the Banking Act number 30 of 1988 required that all the banks has to publish their financial statement annually as well as quarterly. So according to this Banking Act, or as per this Banking Act, there are several directions issued by the Central Bank of Sri Lanka and required the banks to publish their financial statement quarterly as well as annual. We will see that later on. And then there's a Finance Business Act number 42 of 2011, which also required that finance companies, licensed finance companies, to publish their annual report and quarterly financial statements. And then the requirements of the Insurance Industry Act number 43 of 2000, which required that the insurance companies has to publish their annual report, annual statements to the public. And continuing listing requirement of Colombo Stock Exchange, because if those who are listed their shares in the Colombo Stock Exchange also has to submit their quarterly statement as well as annual statement to the CSE, Colombo Stock Exchange. And the Colombo Stock Exchange website, if you go to the particular company's website, the particular company's portal, then you can just you can see that, okay, there are financial statements drop down menu where you can see the annual financial statement as well as annual reports as well as quarterly financial statement. I think it is from 2012 onwards you can get of any company. So I think for the this listed company, so listed finance institution has to give the statements to the CSE, the Columbus Stock Exchange. And the Companies Act also, I think Registrar of Companies required annual statement they have to submit to the Registrar of Company. And relevant regulatory directions and guidelines, other things are required. So these are the legal requirement required that the financial institution has to publish their statement, financial statement to the general public. Okay. Before going to other sections, do you have any questions? Okay. By the way, this Mr. Gamanayaka have completed the financial fraud as well. Oh, fraud is covered. What about the organization structure? I think you would have covered, no, those areas. There's somebody commented in the inbox that whether Mr. Gamanayaka completed the organization structure. I think he has completed, no? Can someone confirm me?
Sir, he covered financial institutions management.
Okay, where there's a organization structure also would have covered, no?
Yeah.
Okay. Because otherwise, I just before exam I have to cover. That's what I just asked. Okay, thanks. So we will move that. This we say that accounting standard, Sri Lankan accounting standard required the required the company's finance institutions to submit the financial statement. So these are the some of the accounting standard which required related to the publishing financial statement of the finance institution. First one is SLFRS 4, which is about the insurance contract. And the second one is SLFRS 7, which which required about the elaborate about discuss about the financial instrument and disclosure requirement. And SLFRS 9 is the famous one. Everybody may know who has the involvement in the financial institution, which is about financial instruments. So SLFRS 9 also required that finance companies or finance institution to publish that thing. And SLFRS 13 fair value measurement, and SLAS LKS 1, LKS 16, and LKS 24 are some other accounting standard which required some certain requirement. When a company or financial institutions publish their statement, they have to follow these standards, accounting standards. These are some of the things. Actually, not all. Some of the important financial statements or standards. Sorry, standards. And we have then the second one is requirement of the under the Banking Act of the Finance Business Act and in the Insurance Industry Act for annual financial statements. So if you see this table, you can understand the first one is the bank, other one is the finance companies, other one is insurance companies. So format is the audited financial statements are for any company, any finance institution. It is generally as prescribed by the accounting standards. But other requirement, there are slight deviations in the other requirement. For example, if it is a bank, if it is a licensed bank, according to the Banking Act, they have to submit the annual financial statement to the regulator within 5 months. The DBS means Director Bank Supervision. So they have to hand over the annual financial statement to the director bank supervision within 5 months. It means if it is a for a bank, the annual generally the annual the financial year ending at December 31st for a banks, uh, then they have to submit before end of May. Before end of May, they have to submit their financial statement to the DBS, Director Bank Supervision. If it is the finance company, then within 3 months period, actually their financial year, other than if it is a finance company, is a subsidiary of the bank, other instances, generally their annual financial statement, financial year is ending at March 31st. So in that case, they have to submit within 3 months, mean before end of June, they have to submit their financial statement to the director supervision of non-bank finance institution, which is one of the department in the central bank. They have to submit their report to them. And if it is the insurance, they have to submit within 6 months to the insurance board. It's actually now IRCSL, Insurance Regulatory Commission of Sri Lanka. So they have to submit within for them within 6 months from the um, end of their financial year. Okay, then publication for the Banking Act, of course, as per the, if it is a licensed bank, they have to publish within 5 months in 3 languages. And if it is the finance companies, they have to publish within 3 months in 3 language papers. For example, 3 language in the sense, one Sinhala, one English, one Tamil papers, they have to publish. Why that requirement is prevail in the market is because the depositors, the general depositors should know the financial condition of particular bank and finance companies. For that purpose only, the regulator, the central bank asked these banks and finance companies to publish their accounts, even 3 languages. So even the layman person, he should be able to identify and understand the financial condition of the finance institutions or bank and finance company. That is the purpose. They asked that, okay, within 5 months, and within 3 months they have to. And customer disclosure, of course, the financial statement at each business place, they have to keep the financial annual report. So if customer wanted to review it or wanted to just check it, then he has to give in that priority, given the annual report or financial statement to view. And panel of list qualified auditors, time to time, central bank, bank supervision department and non-bank supervision department publish the qualified auditors panel. Actually, if a bank or finance companies has to be audited, it has to be audited from this panel of list, panel of auditors. All the auditors cannot audit the banks and financial institutions. Actually, the panel of they have to just select, the bank has to select one of the auditor from this panel list, and the panel auditor can do the auditing of these banks and finance companies. So those are the requirement under the Banking Act and Finance Companies Act, as well as Insurance Act. Okay, before moving to the major disclosures in the financial statement, if you will have any doubt on this, so far the areas we have discussed so far, you can ask. Anything if you want. Actually, we have discussed about what is financial reporting, and then why this finance information is important for different stakeholders, and then we have discussed about the financial statement process, and then we have discussed about what are the regulatory requirement, and then under the regulatory requirement we have discussed about different requirement by the different regulators or the act. So, and then now we are going to move to the major disclosures in the financial statement. Before going to that, do you have any questions? Okay, since you all don't have any questions, I'll just move into the other section, the major disclosure in the financial statements. Why disclosures are important and required? Because we have already discussed it, to provide useful and accurate, consistent, comparable information for decision making of the users. This disclosure requirement is important. We have already, I think we have already discussed about it. Under the first slide, we have discussed about that why financial information is necessary. So this is again saying that, okay, to why we have been the disclosure of information is important is to provide the useful information to the stakeholders. That is the first thing. And the second thing is to comply with the statutory requirement. Why bank has to publish the account is because one is the, as per the Banking Act, they have to publish the account within 5 years. Sorry, 5 months of the from the financial year. So to comply with that statutory requirement, they have to disclose the information. They have to publish the information, and to maintain investors and depositors confident, and thereby to promote the financial system stability, they have to publish their financial statement to the public. So the financial stability is most important, and what they are doing in the financial regulator, they are just ensure the safe and soundness of the individual institutions. Okay, assuming that if every individual institutions are safe and sound, then overall financial system will be safe and sound. For example, in a financial system, there are 5 banks and 3 finance companies. Actually, what they are doing is, regulators is, they are doing that to ensure that each 5 banks are safe. They are just supervising each 5 banks separately and ensure that these 5 banks are safe, and 3 finance companies are safe individually. And then they are assuming that if these 8 institutions are safe individually, then ultimately the financial system stability is maintained safe and soundness manner. That is the purpose of so for that purpose, this financial statement has to be disclosure, and the investor confidence is must important in the finance business, particularly the banking and finance companies business. And to help identifying various type of risk, the effectiveness of the risk management system purpose, they have to disclose the financial statement, and encourage arm's length transaction, no favorable treatment, and prevent unethical practices. Okay, now I am asking a questions where this can be happen. To encourage arm's length transaction, no favorable treatments, and to prevent the unethical practices, they say that to disclose the financial statement. Okay, give me some example where unfavorable treatment could occur in a financial statement, sorry, financial institution. I'm repeating the question. Give some example where unfavorable treatment could occur in a bank of finance companies. What are the instances? Can someone give that, volunteers? What are the instances where unfavorable treatments or unethical practices may take place in a bank and finance institution? Prasanna, do you have any idea?
Granting facilities to close relations of board of directors.
Yeah, exactly. Yes, exactly. That is a one of the place, the related party transactions. That means the board of directors and all, when they are granting the facilities, or when there is any transaction with the related party, there may be unfavorable treatment or unethical practices, which we have, I think we have discussed very in detailed manner. So I think in the accounting statement, there's a separate note generally about the related party transaction. So once they wanted to publish that to the general public or stakeholders, generally the company may not get involved this type of unethical or unfavorable or favorable treatment. Unethical or favorable treatment. Generally, these banks or finance companies are granting loans and advances to, as Prasanna rightly mentioned, loans and advances to the directors and directors connected companies. They are giving loans and advances at a cheaper price or less than the market price. So if they wanted to disclose those things in the annual report, then of course the people may not engage, or maybe in a lesser manner. We can't say, we won't say that it's 100% preventable, but in a lesser manner they may get involved. So that is one of the purpose, to encourage the arm's length transaction, no favorable treatment, and to prevent the unethical practices. They want the disclosure important and required. And to promote the transparency of the information on the affairs of the business and to promote the market discipline, then they need to disclose the financial statement. So these are the purpose. If there is any question in the exam, you have to say why the disclosures are important. Then you have to say to provide the useful information, to comply with the statutory requirement, to maintain the investor confidence, and to help the identify various type of risk or encourage the arm's length transaction, and to maintain the transparency. The disclosing the financial statement is important. I think you got the point. Okay, methods and way of disclosing financial informations. Generally, as I mentioned, quarterly publication of financial statement. If it is a licensed bank or listed bank, finance institutions, they have to publish quarterly publication of the financial statement. And annual report, of course, everybody knows that, and it is very detailed manner. Even companies and finance institutions having sort of competition among them, who publish very nice annual report. If you see the annual report, of course, they will just explain in very detailed manner this risk management and all. But we don't, sometimes we may not see in a practical manner. But due to this competition and all, they nicely publish the annual reports. So that is one of the way, the annual report, publish annual report, quarterly statement, and press releases. If you see in the end of June or end of March, June and end of September quarterly times, maybe after 2 months of the quarter end, you may see the business press releases, the news items, where this bank earning from some higher than the last year this much, and all sort of press releases. That is one of the way to disclose the finance information. Financial information posted on websites. Actually, annual reports as well as highlights and all are posted on the website. Regular reporting to regulators. So that is one of the way disclosing. They are just, I think if it is a bank or finance companies, every month they have to submit reports to the some prescribed format to the Central Bank of Sri Lanka. Even insurance board have that practice, maybe quarterly, or I'm not sure monthly, but quarterly they have to inform all the companies, and SEC also, Securities and Exchange Commission, has to report. Okay, just to refresh, how many regulators are in Sri Lanka? Financial regulators? And how many financial regulators are in Sri Lanka and who are they? Can someone? We have discussed this already. How many financial regulators are there in Sri Lanka and who are they? Yeah, 4 regulators, Gayani. Who are they, those 4 regulators? Yeah, Central Bank of Sri Lanka, Securities and Exchange Commission, Insurance Regulatory Commission, and Cooperative Development Department or Cooperative Commissioner Office. So those 4 regulators are in Sri Lanka. So this finances, the respective institution has to send their financial reporting to those regulators. And of course, to the government agencies, tax authorities, and etc., they had to send. And prospectus pertaining to the issuance of common stock and other securities, the financial statement, last 5-year statement. Generally, if a bank or finance companies or any other companies, they want to issue for debentures, or they wanted to issue, go for an IPO, initial public offering. What they have to do is they have to publish prospectus. In the one of the prospectus, one of the section is about the financial condition. So generally they publish the accounts and last 5 years performance. They just publish it, and they compare the last 5 years performance in a nice way. So it is prospectus is sort of advertisements. So what they will do is very nicely they will elaborate the financial condition of the particular banks and finance companies, even other companies, when they are publishing the prospectus to issue the debentures or stock. Okay, so these are the ways generally company disclose their financial statement: quarterly publication, annual report, press release, and websites, as well as regulators handing out to regulators, government agencies, and prospectors. Okay, and applicable laws and regulation on disclosures, we have already discussed about it. First one is Sri Lankan accounting standards. Under Sri Lankan accounting standard, LKS Sri Lankan Accounting Standard 1 and SLFRS 7 and SLFRS 13 and LKS 24 are directly involved with the disclosure of financial statements. And corporate governance disclosure, Central Bank and SEC and Chartered Accountant of Sri Lanka, they just required the accounting the requirement on the information, financial information. If you see the annual report, they nicely write on this corporate governance structure of the particular banks and financial institution. And again, Basel 3, Pillar 3 market discipline required that capital and risk management requirement. That's what this, even in the annual report, you can check some annual report. For example, I would recommend you any of the bank. Maybe I saw the bankers loan last time publication. It was very nice, and they have written nice risk management things and all. You can just download it. It's available in the website. You can download that and read it. So even any, not only bankers loan, any banks, you can, there are nice reports, so you can just read it and get some idea. So they actually, the risk management, they say the three lines of defense and everything has been nicely written in the annual report. And SEC continuing the listing requirement, then there are some legal and requirement. Global reporting initiatives also required some requirement. So these are the applicable laws and regulations on disclosure requirement of the financial institutions. And this is, of course, we have already discussed. I think we need not to elaborate much, but I just going through it quickly. the primary financial statement. There are 5 primary financial statement. First one is a statement of financial position. It's a balance sheet. We generally known as a balance sheet. So that is one of the primary one. And second one is statement of comprehensive income, profit and loss account. It has 2 parts, P&L and other comprehensive income for a period. OIC, we OCI. We say that's a OCI, other comprehensive income statement, and P&L statement. So there are some 2 subsection, but generally we can say that profit and loss account is one of the prime financial statement. And statement of changes in equity, statement of cash flow, accounting policies and notes to the financial statement. Those if there is anyone not related to the accounting and finance department works, I just wanted to elaborate them. This notes to the financial statement is end of the financial statement. There are some written notes which will give additional information about the financial statement, which is called notes to the financial statement. So accordingly, there are 5 primary financial statements we can identify in a financial statements, disclosure in the financial statements. And on top of that, there are risk management disclosures, which is also important as financial statements. And in the risk management statement, the financial institution has to say on quantitative and qualitative manner what are the financial statements, and as a notes they have to disclose the risk. If there is any, for example, if you say the contingent liabilities, you can see end of the notes, there may be a note called the contingent liability. So auditors and the management has to ensure that, okay, there are contingent liabilities, but there may not be substantial losses incurred through that contingent liabilities. For example, for you can see obviously there may be some litigation going on. Somebody would have filed a case against a bank and asked the compensation. Sometimes labor, sometimes ex-employee would have filed the case against the bank, particular finance institution. So they may say, okay, even though there are some litigations going on, but there may not be material losses to the bank from that litigations. So this is one of the risk management disclosure. Okay, because this particular financial statement is giving the position of the company as at that day, but okay, it will give some futuristic condition also. So that type of information and summary of the quantitative data about the exposure of each type of risk, and management's objective, policies and process for managing those risks. And that is why I have already mentioned that if it is annual report, there are nicely written notes on this risk management disclosures, which is available in the annual report, and disclosure about the credit risk, liquidity and market risk, operational risk, interest rate risk, and how these risks are managed, and changes in respect of risk management practice from the prior period. Okay, since we have mentioned in the interest rate risk, I would like to ask from you all that these days the interest rates are on the upward trends. It means the interest rate earlier it was very low level at a 4%, 5% level. But if you see the last week treasury bill auction, the 3 months treasury bill went up to 8% level, 8.04% level. So the interest rate curve is in the upward trend. Okay, when interest rate curve is on the upward trend, what will happen to the financial institution, particularly in their profitable? What will happen to the financial institutions' profitability through their investment portfolio? Okay, during the upward trend of the interest rate, what will happen to the profitability of the finance institutions? Can someone? During the upward trend of the profitability, what will happen to the profitability of during the upward trend of the interest rate, what will happen to the profitability of the finance institutions? Whether it will be favorably affect or whether it will be adversely affect to the PNL, what will be there? Just to get some idea. Can Sanjeev say something?
Maybe the money supply is high. In order to curtail the inflation rate, they might have increased the interest rate. So now the private banks, they have to keep more money with the central bank. So hence the profit, there will be a dip in the profitability of banks. Marginal.
Yes. Yeah. Profitability, but the direct connection is when interest rates are increasing or upward trend, what will happen is fair value of their investment portfolio will decline, because there is an inverse relationship between the interest rate and fair value. Okay, then if it is the interest rates are going, market interest rates are going up, their fair value of the portfolio will come down. Then that mark to market losses will adversely affect the profitability of the banks and finance institutions. That may be a more accurate answer. What the point I understand? Or do you need any
Yes.
further explanation? When interest rates are increasing, they may have some financial portfolio. So there is an inverse relationship between the interest rate and fair value of the particular portfolio. So interest rates are increasing, fair value will decline. Then in that scenario, they have the portfolio will incur mark to market losses, and that mark to market losses will have negative effect on the profitability. And as Sanjeeva mentioned also, okay, the bank has to compel to increase their interest rate, then they may lose their businesses as well. And that may have a adverse impact. But of course, what they will do is they will increase the deposit rate, as well as they will increase the loans and advances rates as well. So generally in Sri Lanka, the interest rate the margin, interest rate NIM, we just call as a interest income margin. It is generally they maintain always 4% and 3.5% level. So generally, if it is interest rate increase, what they will do is they will adjust the deposit rate, as well as they will adjust the lending rate. So by adjusting both, they may maintain the margin. But the general effect may created through the investment portfolio. If they have the treasury bill or treasury bonds or debenture portfolios, what will happen is if it is in the trading book, they have to mark to market. And if it is a then mark to market value will hit the P. Okay, and this is, I think we have already discussed about that the areas and major disclosure risk management framework. What are the disclosure under the risk management in the annual report? Generally, first they will elaborate about the risk management structure of the particular bank. It may be different from the banks to bank. If it is a small bank, their risk management framework will be different from a international bank or global bank. The global bank, they may have different and very strong risk management framework, because they have to they are having the global network. But if it is a small banks within the one judiciary, it means within one country, they may have very simplified risk management framework. So whatever the risk management framework, they will disclose those framework in the annual report with the annual statement, financial statement. And then credit risk. That is one of the other risk management disclosure they have to maintain. They have to disclose the credit risk, of course, their credit quality of the financial assets, age analysis of the assets and past due assets, impairment, risk exposure of the internal and external rating. Likewise, there are several things they will disclose of the credit risk management. Of course, the credit quality earlier, just for your information, I am giving that earlier central bank requirement is the credit quality. There are substandard, doubtful, and lost category. There are three categories, and observe if it is 3 months due, they have to classify into non-performing. Under the non-performing, there are several categories. But now it is stage 1, stage 2, stage 3 according to the IFRS 9, SLFRS 9. So this credit quality and all those kind of information will be disclosed under the credit risk. And then again, the liquidity risk and funding management, there are so many things they will disclose about the liquidity risk, and mainly they will disclose about some liquidity ratios. We will look into that later on. SLAR, statutory liquidity asset ratio, and liquidity coverage ratio, rupee and for foreign currency. Likewise, there are different liquidity ratios, so they will disclose about those liquidity ratio and past information. They will give some time series information about it, and they will give nice analysis on finance assets and liabilities. And the market risk, under the market risk, interest rate risk, which I have discussed now, the interest rate sensitive assets. In a bank and financial institution, there are so many assets, but assets can be divided into two. One is interest rate sensitive assets, other one is non-interest rate sensitivity assets. Interest rate sensitivity assets means whenever the interest rates is going up and down, there some assets, the value of some assets will increase or decline. So those assets are called interest rate sensitive assets. So they will disclose about it, and impact on the PNL and PNL due to interest rate shocks also will. That's what I have just explained to you all. When interest rate is going up, portfolio value come down. So those shocks will be. Actually, if it is a global banks and all, sometimes they may just publish stress testing analysis. Okay, if interest rate is going up by this basis point or this much of basis point, what will happen to their portfolio value? And what is the mitigation they have taken? All sort of analysis will be disclosed in the annual report. And then equity price risk, of course, when bank having the equity market investments, then they will disclose about the equity price risk, and current risk stress testing and all they will disclose. Okay, what is the meaning of stress testing? Before going to other section, because I think there were some instances, there's a short notes about stress testing. What is the meaning of stress testing? Any volunteers? What is the meaning of stress testing? Stress testing is an assessment where they assume in an adverse scenario what will happen to the bank balance sheet and P&L, or directly what will happen to the capital. It is there are some adverse scenario. They in the future they may assume, okay, for example, if I say that example, that they say that okay, in future the NPL ratio, non-performing loan ratio of a particular bank increased by 10%, what will happen to the capital of that particular bank? Okay, that is one of the scenario in this stress testing. Okay, their current NPL ratio is 5%, but due to this adverse pandemic situation and all, most of the borrowers are defaulting, and if the non-performing loans increase by another 10%, it means from 5% to 15%, what will happen to the capital of the bank? Why what is the relationship? Actually, what will happen is, if there is an additional NPLs, non-performing loans created, then what the bank has to do is, bank has to make additional provision for those non-performing loans. When they are doing the additional provision, that will hit the PNL of the particular bank, and that in adverse impact then directly hit the capital of the particular bank. So the increasing non-performing loan of a particular bank, what will happen to the ultimate effect to the capital of the bank? The stress testing is sort of very vast area. In simple way, by assuming some adverse condition, assess what will happen to the balance sheet of the particular bank or finance institution is called stress testing. Okay, then other risk disclosures, they will make it the operational risk disclosures. Of course, operational risk, they will just they will disclose about the internal frauds and legal case. I have already mentioned the notes. If there is any legal case, important legal case and all, they will make a loss. They will make a disclosure. So in an annual report or financial statement disclosure, they will disclose this type of risk management information as well. Their framework, credit risk, liquidity, market and operation risk. And these days, of course, they may disclose about the IT risk also, because IT risk is most important risk in the current scenario. Anything you all wanted to ask, or shall I move to other one? Before going to the related party, I just wanted to clarify whether you have any questions. Okay. Then, as I mentioned already, in the notes, one of the important component of the notes to the financial statement is related party disclosure. Even accounting standards require this related party disclosure, as well as regulators. The Central Bank of Sri Lanka required the related party disclosures. So information on the related parties, we have to the bank and finance institution of finance companies has to inform to in the disclose in the bank accounts, financial statements. The related party transaction, if there have been transaction, nature of the related party relationship and all. Okay, before going to that section, I just like to ask you all, who are the people could be considered as a related party? Who are the people could be considered as a related party? We have already discussed this section. That's what I am asking. Who are the people could be considered as a related party of a bank and finance companies? Can someone?
Immediate family members, wife, son, and a director who was holding a position in another organization, also having a director position in another financial institution. So in order to grant some like procure some items to the financial institution, he is using the power of the other directorship in order to get the goods at a lower rate. So that also can be a
Yes. Actually, that is the answer actually. So there are several parties are considered as the related parties. One is the directors' direct relations, maybe spouse or the children's, the unmarried children's, or it's depend on the definition, but unmarried children's or the children's below 21 years old. So, and if it is a company, the common directorship is existence. That is, and if it is the if it is the spouse or children of senior management, if it is the if it is the related company of the major shareholder. Likewise, there are some, we have discussed already, there are criteria to identify the related party. So once they identify as a related party, and if there is any transaction that they are related party, then those related party transaction need to be disclosed in the annual report or the financial statement. The first one is nature of the related party relationship. Okay, the nature means, okay, how you have considered this related party. Maybe maybe a director's spouse, or maybe a major shareholders transaction related to the major shareholders transaction or something. So nature of the related party relationship has to be disclosed, and information about the transaction. It may be procurement of any software, or it may be deposit or mobilizing deposit from that particular person, or it may be hiring anything, any machinery or any vehicle or anything, likewise, or granting loans and advances. So information about the transaction has to be disclosed. So first one is they have to disclose about the nature of the related party relationship, then information about the transaction, and information about the outstanding balance. For example, if the loans and advances, generally in the banks and finance companies, loans and advances have been granted. Okay. So initially, how much of the loans and advances granted, and currently what is the outstanding balances. So that information has to be given. And information about the impairment, bad debts with related to related party. Actually, which is the case most dangerous in the banks and finance institution. Generally, the related parties are getting loan from these finance companies, even or finance companies or banks. And what they do is they don't repay it. Since it's a related party, the recovery people also reluctant to push the people. So what will happen is it will go as a bad debt, and after some times the management will decide to write off those loans. Then it will be ultimate loss to the depositors. So that's why they had to mention about information about any possible impairment or bad debts with related to the related party. Then, okay, then the shareholders will get to know that, okay, this director borrow this much of money, but he were defaulted or something. Then this much of earning they had indirectly. Likewise, it may give additional information about it. So that is the fourth information. And fifth one is these should be disclosed for each category of related party. Example, parent, subsidiary, associate, joint venture, key management personnel, and major shareholders, other related parties, they have to mention. Even if it is any transaction with the subsidiary company, it will be considered as a related party, and associates and joint ventures. It may, for example, in some groups, we can identify there may be a bank in that particular group, and all the related subsidiary companies are given the loans, cheaper loans from these banks. So they are just using to pump the liquidity of money to those subsidiary companies from the bank at a cheaper rate. And sometimes it may go as a bad loans. So what, by using this bank, what they will, even the common owner, what they will do is they will using this bank, they may create so many related company or subsidiary associate company within the group, whereby burden the particular finance institutions. So those are each under each category, it has to be disclosed. And if it is a short-term employee benefits and post-employment benefits, this is generally they have to, if it is some senior management, even the other management, even the loans and advances granted to as a staff loan has to be disclosed. Not the name wise, but the totally they are just disclosed. If there is any general scheme, they will say there's a general scheme and this much of has been given to this number of employees. And post-employment benefits and other long-term post-employment benefit also one of the important. For example, in some companies, in the foreign companies, you may heard about it. The CEOs are given so much of this retirement benefit at the time of retiring. So that is also one of the other place where we can see some irregularities. So post-employment benefits also has to be. Other long-term benefits and termination benefit, share-based payment. And share-based payment means employee share ownership schemes may be. There may be some employee share ownership plan. Under that, if there is any share-based payments, they have to disclose to that in the annual report. Because this is to keep the balance between the stakeholders and management. The stakeholders may be the company owners or other owners or other institution, other owners or employee or any other people, investors. But to keep the balance, they have to disclose and keep the transparency. Why all these disclosures are required is maintain the transparency. Okay. Anything you all wanted to ask before moving to the corporate governance? Okay, then there is other disclosure requirement, which is corporate governance disclosures. We have seen that, okay, the bank has to maintain the quantitative and qualitative informations. Generally, other four financial statements, other four means balance sheet, P&L, equity statement, and cash statement, cash flow statements are given information about the quantitative information, are generally giving quantitative information. But notes to the financial accounts giving qualitative, some qualitative information as well. And this one of these qualitative information is corporate governance disclosures. The corporate governance disclosure, why it is important? Because when you are, again, when I am mentioning it, when somebody invests in the stock market, you have to assess the quantitative information about that particular company as well as qualitative information about the particular company. The quantitative information means net asset value, ROE, return on asset, equity, return on assets. Likewise, there are quantitative informations. And when they are investing in the stock market or particular shares, they have to consider about the management, particularly the honesty of the particular management and governance structure of the particular company. Sometimes you may see some companies are flourishing in a good way at a particular short time. And after that, in the long run, that company may go bust or bankruptcy because of these corporate governance issues. because for sometimes even the directors themselves may manipulate some things. So to ensure that, or to avoid such a situation, what we are doing is, or what the requirement is, they have to, or each and every company has to, financial institution has to make corporate governance disclosures. So what they have to do is, first they have to say about who are the chairman, CEO, board of composition, profile, experience, qualifications. If you see the annual report, you can nicely see that actually when we are taking the annual reports, what we are doing is seeing nice pictures of this board. But we don't read it. Most of the people don't read it. Actually, what we are doing, you have to read it. Okay, what is the board composition? How many independent directors are there? How many non-executive directors are there? And whether the chairman is a non-executive director or executive director. What about the CEO and all sort of things can be get it from this board of directors disclosure in the under the corporate governance. And then board appointment committees, they generally they disclose the objective and composition, structure, function of these committees. There may be 4 or 5 committees related to the company, maybe the audit committee, nomination, remuneration, risk management. Likewise, there are several committees. So how this committee functions, even the committee functioning sub reports are given in the annual report. And transaction with the related party. This is one of the disclosure requirement. The related party transaction also under the corporate governance, if it is related to the management and all, they have to disclose. And key performance indicators, which is most important, and we will see that key management performance indicators in the subsequent section, which is most important and which is important for exam as well as your personal things. Key management performance indicators, KPIs, which also has to be disclosed under the corporate governance disclosure. And various disclosures under different reports, they have to maintain under the corporate governance disclosure. And other thing is, which is very important, fair value disclosure, which is in the accounting point of view important, and under the IFRS 9 or SLFRS 9, this fair value reporting is must important for a bank and financial institution. Why this fair value report, as a financial, the fair value disclosure is important for a bank compared to other companies? Why? I'm saying you all that the fair value disclosure is important, and under the SLFRS 9 for financial assets, they have to have the fair value reporting, and the techniques to the fair value reporting is much important for a bank and financial company or insurance company, particularly the financial institution. Why it is important for a financial institution compared to other companies? For example, if it is a production oriented company, or for example, if it is a John Keels or Kaylee's or any other Singer Sri Lanka or any other companies, compared to that, this fair value disclosure is important for a bank like commercial bank, HNB, bankers loan, like the or finance company, LB Finance, or like that. For the banks, it's important than the other companies. Why? Prasanna, do you have any idea? Why the fair value disclosure is important for a finance institution than other type of companies? Gayani? It's very simple question. It's don't think about too much. It's very simple. If you think about the financial the structure of the balance sheet, you will get the answer. Why the finance institution have more important on this fair value disclosure? Sanjeev, do you have any idea?
Maybe they don't want to carry certain assets at more than what they deserve, like because if one of the asset price is 100,000, and as per the requirement, they don't have to publish it as 120,000. So fair value is much important for that only, I think so.
Yeah, but even other companies also, they should not report the 100% and the 100 billion value assets to 120. No, why it is for particularly we are saying and to the giving more emphasis to the finance institution.
Because we are running on public deposits, so we should ensure the public confidence towards the financial institutions.
Yeah, that is one of the answer, because we are running with the public confidence is much important. But why don't you think that it is more important because these finance institutions are having more financial assets, and financial fair value treatment, even though it is applicable for all the assets and liability, for fair value is more important for a financial assets. It's applicable for the financial assets. So compared to, for example, compared to John Keels, the commercial bank may have more financial assets. Then, for example, it may be investment in treasury bills, investment in treasury bonds, and SLDBs, maybe sovereign bonds, or maybe equity investments and all. So fair value for this finance, it may be one third of their, more than one third of their balance sheet, maybe one third of their balance sheet. For this fair value treatment or fair value disclosure is most important for a bank and finance institution, since they are having more financial assets. These other companies, they don't have much financial assets. That is one of the reason we are giving more emphasis on this fair value for finance institutions account. And under this financial fair value treatment, there are several methods we are following. First one is quoted price for similar instrument. For example, if you are having the shares, X company shares, and at the end of the month, that shares is quoted at 120 rupees or 150 rupees, then it is easy for us. Okay, just take that quoted price of the similar instrument and just do it the fair value. And directly observable market inputs other than the level 1 inputs. Okay, the level 1 inputs we are just matching. Okay, if it is a X company share, for example, we say okay, it is a Singer Sri Lanka shares. Okay, if they have the shares in the Singer Sri Lanka, they can just match with that the price traded in the similar product instrument and just get it the level 1. That is one the first way, and easy way also. The second one is directly observable market, because there is no particular traded for the particular similar instrument has not been traded in the market. You can take that example in the treasury bond market, particularly. In the treasury bond market, there are the treasury bond, there may be 65 series are there. Different type of when the central bank issuing the treasury bond, what they are doing is they will open a series. In that particular series, they will issue some shares, the treasury bonds. Okay, and the next time when they are issuing other one, they will open another series and all. But sometimes they may reopen this, but generally you may just think about it, there are 60 to 65 series are available. Okay, particular bank has a particular series. For example, series number 10, particular bank having. But there, the particular day, there is no any bond traded in the series number 10. Okay, then there is no similar asset case. The level 1 we cannot match. What we can do is we can find, okay, then series 10 is remaining maturity is 5 years. Okay, then what we can do is we can just check whether is there any assets, any treasury bond traded, it may be other series traded with a close to the 5 years maturity one. Then what we can do is we can take the value of that bond and match to this the valuation of this particular treasury bond. Generally, for the government securities, they are just taking, because in Sri Lanka, of course, government securities market is very illiquid. Trading are very less, tradings are taking place every day. So compared to the overall market size, for that the level 2 treatment can be applicable. And third one is inputs not based on the observable market data and based on the best available data that can be from internally or externally. Where it may be, for example, they may have investment in debentures. So there is no market. Even there is no comparable market also for treasury bond, of course. Okay, if even though it is not traded particular series, there may be 5 years the central bank publish every day. Okay, 5 years, what is the trade? 2 years, 3 years, 4 years, 5 years, 6 years. Likewise, there are some benchmark rates. So you can just get it from that. But for debentures, of course, it's very rare transactions, very liquid market. If you have the 5 years bond, sometimes there may be 5 year bond traded in particular month itself. So internally you may have some sort of idea. Okay, maybe some basis point above the treasury bond, particular treasury bond, or likewise there may be. So that is the way the level 3 will. And other one is if these things are not available, then they can go for a book value method. For example, if it is an investment in particular company which are not listed shares or some like. So there are different fair value method and different fair value method techniques are available, and these techniques has to be disclosed in the market. Okay, which technique has been used for that. And again, that is accounting treatment, and Pillar 3 disclosure requirement is related to the Basel 3. Which is effective from 1st July 2017. For a long time, we are one of the country in Asia. We have implemented the Basel 3, and under that, they have to disclose on capital and liquidity, risk-weighted assets and capital planning and regulatory and accounting treatment. And there are some templates, and quarterly, annually, they have to disclose that information to the stakeholders. So which is one of the area you can just discuss on it. You can just if you want any additional information, you can get that information by reading relevant material. But it's better to just to have under the Basel 3, the banks, particularly banks, has to have a disclosure requirement on their capital and liquidity and their capital plan. For example, bank has the idea to expand their business activities. Okay, when they are expanding their business activities, they must have the more capital, because when their risk is high, they have to keep more capital. So what is their capital planning and all, and that discussed under this Pillar 3 disclosure of the banks. So I think before moving to this financial performance analysis, which is one of the important thing, it is giving idea for you all and ratios about the different key performance ratio. We can discuss this on the next class. If you have any doubt on this, so far we have discussed, I can clarify you all, or otherwise I can just what I can do is I can ask questions. Any doubt? So I think you all may have now understanding about the disclosure requirement of the financial state of the companies. So we have discussed about what is the process of financial statement, and why the financial statements are important for a different stakeholders, and what are the legal requirement. And the legal requirement, we have seen several requirements and risk management requirement and related party and corporate governance and everything. So we will have sort of a foundation idea about the financial statement and the statement, the publication or release of financial statement of a company and financial institutions. Now we are going to move into the next. We are going to move into the key performance indicators, which is important for exam point of view, and you may get one or two questions related to that. Okay, so before moving to that, if you have any questions, and otherwise, do you have any questions? Okay, friends, and then okay, and I'll just wind up the class with this point. So in the next class, we will start from the financial performance analysis, and then we will move to the external audit. I think, and so it is the next class we have to discuss in a detailed manner. So I think it may take time for me. So next class we will discuss on the financial performance analysis. Then we will move to the audit, external audit part in the following class, and with that class we can finish the this semester. If you actually we are moving towards the end of the semester, if you'll have any questions, you can just drop me an email or just send me. We can just discuss, or you can even in the class you can ask the questions. I'm ready to answer. Okay, with that note, we will wind up this class, and we will continue the next class. See you. Bye.